What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday, everybody. As many of you are probably aware, this week China saw the tragic crash of flight MU5735. An investigation is now underway for China's worst air disaster in more than a decade to try and understand how the plane suddenly fell from the sky on Monday and crashed on a mountainside in South China's Guangxi region. Though this is indeed a tragedy for those families involved, unless the investigation transforms into a bigger development on the national or international level, it's currently not within the scope of this channel, which looks at political and economic macro developments and trends, so we will not be exploring the accident too much. I will follow the case, however, and see whether it evolves into anything bigger, and if it does, we'll do a deeper dive then. We hope the families can get some closure from the investigation and are receiving the support they need. Okay, first up, last week we discussed the Financial Stability and Development Committee meeting led by Vice Premier Liu He, which stepped in last Wednesday to stop the bleeding of Chinese equities, particularly stocks, resulting in a nice rally of many Chinese ADRs in the US market and stocks in Hong Kong and the mainland, and especially technology stocks like Alibaba and Pinduoduo, albeit from a very low base. By the way, tomorrow we will be doing a deep dive into the Chinese stocks and the Chinese stock market over the last week or so, and discussion about what we should expect in the coming weeks. Now, if this Financial Stability and Development Committee meeting was not evidence enough of nervous policymakers in Beijing looking at the economy and capital markets, then moves from Beijing this week for further stimulus should be. On Monday, a special meeting of the State Council, China's cabinet, chaired by Vice Premier Liu He's boss, Premier Li Keqiang, announced more tax rebates to businesses to, quote, shore up economic stability, end quote, and specifically called for, quote, targeted measures to boost confidence in capital markets, end quote. Nearly 1 trillion RMB, approximately $157 billion of tax rebates will be directed to small and micro enterprises and individual business owners. Now, this line, targeted measures to boost confidence in capital markets, is very important. It's important because it is signaling to investors that Beijing is prioritizing stabilizing equity prices. This in turn could cushion investor confidence and maintain stock price rallies that we've seen over the last few days, in the short term at least. One of the factors that fueled this most recent bloody sell-off of Chinese stocks was fears of renewed regulatory crackdowns in the technology sector. So this is a strong signal once again that Beijing is likely going to back off this, again in the short term at least. Now, all of this, including the announcement on Monday of this extra stimulus, may end up being too attractive a speculative opportunity to pass up for some investors, both domestically and overseas, with high risk thresholds. For example, fund managers with BlackRock Inc., the world's biggest asset manager, expressed on Monday, soon after the announcement, that Hong Kong traded stocks have become quote-unquote extremely attractive after recent declines. In a letter to investors, the fund managers expressed that in a crisis, some valuations can reach levels previously not thought possible. Now, there'll be more on Chinese stocks, like I said, and the difference between those that are traded in the mainland, Hong Kong, and on the US exchanges in tomorrow's video. Let's move back to the State Council meeting for now, though. According to the meeting readout, an additional 1.2 trillion RMB in transfer payments will be, quote, allocated to support community-level efforts to implement tax rebates and tax and fee cuts to ensure employment, end quote. The State Council said tax rebate funds should go directly to businesses, and subsidies to local governments should go directly to cities and counties. Authorities will crack down on tax evasion and tax fraud, according to the statement. During the recent 2 meetings event in Beijing, Beijing set a growth target of 5.5% this year, the lowest rate in decades, but a rate that many economists believe is quite high. Almost every few days now, we are seeing a new sign that Beijing is moving back from last year's commitments to deleveraging and redistribution in favor of the traditional goal of growth or at the very least, stabilizing growth. Last week, for example, we covered authorities suspending a plan to expand the pilot property tax trial this year. Official data showed a modestly decent start to the year for the Chinese economy, with the hits to the property sector being counterbalanced by front-loaded infrastructure spending at the local level. However, since this month, the economy has taken a serious beating with the recent COVID lockdowns and a volatile international environment. By the way, guys, if you're enjoying the content, don't forget to hit that like button. It's a huge help for a small channel like this. If you're watching for the first time and you're enjoying the content, you're getting some value from it, I release one of these every day. If you want to be on top of the world's number 2 economy, maybe consider subscribing. Okay, China published its 14th 5-year plan for energy development this week, and its goals are quite ambitious. According to the plan, China aims to have 3,000 gigawatts of generating capacity installed by 2025, up from 2,200 at the end of 2020, while committing, rhetorically at least, to reaching long-term climate goals. Analysts point out that the 800 gigawatt growth goal is about twice the size of India's entire power fleet. Bloomberg's Hong Kong unit reports that China also plans to boost gas production and keep oil output at high levels as it seeks to improve energy security amid rising global commodity costs. The ambitious power capacity target, quote, comes as China ramps up renewable installations which operate for fewer hours over the year than traditional thermal plants and therefore require more capacity to generate the same amount of electricity. End quote. For anyone interested in some of the specifics of this energy plan, I'm not going to go through it here, but Bloomberg's Hong Kong team has provided a nice summary, which I have included in the description below. So check that out if you're interested. But moving on to the third part, and this is perhaps one of the most important stories or developments to be following, Evergrande and China's ongoing property crisis. And Evergrande is not having a good week. As we discussed yesterday, on Monday, trading was halted for the stocks of China Evergrande Group and 2 of its units on the Hong Kong Stock Exchange. Trade in onshore bonds issued by Evergrande's flagship unit, Hengda Real Estate Group, were also suspended. Then on Tuesday, yesterday, China Evergrande Group said that it would not be able to publish its financial results for the year by March 31st, as required by stock listing rules, as audit work has not yet been completed. The same applied for the 2 Hong Kong listed units that were also suspended on Monday. These are China Evergrande New Energy Vehicle Group, which we remember only started selling its SUV model in China this month, and Evergrande Property Services Group. By the way, that electric vehicle subsidiary, a year ago, it had surpassed Ford in market capitalization, but since then, it has lost more than 90% of its value. According to the stock exchange filing submitted by Evergrande, the auditor has added a large number of additional audit procedures due to, quote, drastic changes in operations since the second half of last year, end quote. But that is the least of Evergrande's worries from this week. We also learned this week in another filing to the Hong Kong Stock Exchange that lenders to a property services unit of China Evergrande Group have claimed more than $2 billion worth of its cash. According to the Hong Kong Stock Exchange filing, lenders to the subsidiary had taken over 13.4 billion RMB, $2.1 billion of the company's deposits that were pledged as security for so-called third-party guarantees. This is yet another nail in the coffin for Evergrande, which is struggling to complete hundreds of projects across the mainland and service over $300 billion worth of liabilities as it undergoes the largest restructuring process in Chinese history. This is also a serious blow to international investors in the crisis hit real estate developer who were hoping to recoup some of their losses through the subsidiary. With the UK-based Japanese-owned Financial Times writing today, quote, the claim stands to hit the remaining value of Evergrande's international bonds, which were already trading at a fraction of their $20 billion face value following the company's default late last year. A bond maturing in 2025 is trading at 13 cents on the dollar, end quote. This is almost a 90% value drop too. China Evergrande Group's property services unit is now investigating how banks seized this 13.4 billion RMB of its deposits that were pledged as security. This amount seized by banks accounted for nearly 96% of the property service unit's entire cash holdings as of June last year. While we're on the developer, Evergrande also said on Monday that it has hired Hong Kong-based law firm King & Wood as an additional legal advisor, having already appointed Beijing-based Zhonglun law firm as a legal advisor back in January. Evergrande also said on Tuesday that it will unveil a debt restructuring proposal for its creditors by the end of July. That is, if there is anything left to leave to them. More on Evergrande, the property market, and the Chinese economy later this week. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.